Howdy, folks. It's Jeff Camarda. It is Monday, June 8th. And gee whiz, I'm happy to report, though a little bit surprised, of course, that the rally continues in U.S. stocks with a great deal of gusto toward the finish. I'm sorry about the glare in his glasses, by the way. I've been looking all around to see where the reflection comes from. I'll see if I can find anti-glare glasses. But the rally continues, and in many ways, this is, as often noted by myself and other pundits, a very frothy rally. And a correction at some point is inevitable. And a couple of things I'd like to point out. The first is so-called market index distortions. There are a number of pieces over the weekend in Barron's and the Wall Street Journal noting that many, if not most, U.S. stocks are actually down substantially for the year. But the S&P 500, remember, is a market cap weighted index. It is heavily influenced by the 3 million ton gorillas that comprise it, like Google and so forth. So it's really, the index is really showing the outperformance of a couple of really, really big players, while most stocks may be languishing. And remember, the Dow Jones Industrial Average, Dow 30, which is a popular index as well, is only 30 stocks. It's only 30 stocks. It's not representative of the thousands of stocks that comprise the U.S. stock market. There's also been a lot of mention that there's been a rotation into value. Growth stocks have dominated market performance really since the bottom in March of 2009. And there's been a spate of value outperformance. As you know, by disposition, Camarda is a value shop looking to buy really good companies that are cheap. Hopefully, this value rotation continues. There's a lot of really good deals out there still. Value stocks, according to the Journal over the weekend, are still down some 20% for the year. So there's a lot of opportunity, but we're not quite ready to pull the trigger. When we do Caesar, certainly the Caesar portfolio, the next wave will be heavily focused on quality stocks, good companies that are viable in the current economy, that are still relatively cheap and pay nice dividends, but not really quite to pull the trigger. Now, the bottom line is stay cool. I know it's really easy to get excited and frustrating, but hot money rallies never last. The time to buy is when folks are scared, not exuberant, and hardly no one is scared right now. I've also, Common Kim picked this up over the weekend. Actually, this is my bedtime story as I fell asleep last night. But the catalyst for the current rally is the sharply lower unemployment numbers from what was expected on Friday. And I'm not sure where she found this nugget. I didn't see it in the mainstream news, but apparently the Bureau of Labor Statistics, whoever publishes these numbers, is including in the unemployed folks that are in fact unemployed but receive stimulus checks. So they got stimulus checks, but they still ain't working. So I'm not sure, what the motivation for that particular metric is. Hopefully it's not politically motivated. But I certainly take that number and this linchpin of the current market rally with a whole shaker of salt. Final thing is a financial planning moment. And I'm going to take this. I really can't read. I'm sorry. The financial planning moment is have a living trust. Most of you should have living trusts, not so-called testamentary trusts, the kind that are in your will because they subject you to probate and publicity. They're not private and they're expensive, probate fees, and you have guardianship risks and so forth that we have talked about in previous videos. But today I want to focus with the fact you have to actually put the assets in the living trust for it to function properly. I mean, they'll probably wind up in there at death via your will, because if you have a living trust, you have what's called a pour over will typically that says if I forgot to put stuff in my trust while I was alive, dump it in, pour it over and into the trust at death. But it functions a lot better if the assets are properly titled to the trust. And what should be in a trust? Well, you don't want to have qualified plans like IRAs and 401ks. And in Florida, you typically don't want to have your homestead, the real estate, but pretty much everything else should be titled to the trust and for asset protection, including LLCs. But that's not the point of today's video. So your businesses, non-homestead real estate, investment accounts, those that would be just in your name or joint names and so forth, should be in your trust. And while Camarda tries to be real good about reminding you of this, remember that, and it's your responsibility to make sure that you have everything, particularly non-investment advised assets like real estate, businesses, and so forth. And gee whiz, the lawyers, are really pretty good about telling you this. They may not beat you over the head with it, but let you know at the time the trust is drawn. And some of them will give you a sheet of instructions. But it really is your job. And remember, to put a piece of real estate in a trust, you got to change the deed, right? And if there's a mortgage on it, then you have to get the lender's permission. So it's not, usually you need to get an attorney involved with title transfers. But anyway, tuck that down, write it down, because some of you probably have trusts and probably forgot what the recipe or the instruction manual that came with the trust was, or is it described to you. But that's really, really important for a living trust to function properly. It must be the owner of the appropriate assets, which typically are going to be your non-homestead and non-qualified assets. And that's enough for now. So until tomorrow, Super Tuesday, in a financial sense anyway, we'll be chatting at you tomorrow, June 9th, right here from the same old chair, and I'll see if I'll put sunglasses on or something to get this annoying glare out of my eyes. So sorry, and wishing all of you a placid, peaceful, prayerful, and positive evening. Until tomorrow, this is Jeff Camarda signing off.